upon the Halloween hour, and we are coming to you all live with some spooky news about the stock market recently. Um,
Facts.
the reason why we say spooky is some of you all have been scared looking at the market. So we're going to talk about that today. Before we start talking about it, again, I want to say thank you to everybody who's been listening to our podcast, who's been sending us these supportive text messages and emails. Those of you all who are subscribed to our platform, I know you're finding some of the information we're posting to be very useful. And also, we've learned that many of you all like plan your day around watching the replays of these live podcast recordings. So, thank you for that. If you are thinking about becoming an IEA member, you can go to IEA Now, IEANow.com. Become a member, find whatever package. We have packages range from $18 a month all the way up to $5,000 a year, which soon will be $10,000 a year. But for now, $5,000 a year, depending on how you want to become connected to Investing Education Academy. Also, we have some exciting news. We're going to be talking to some businesses, really some schools in the next coming months about possibly incorporating Leon software into some of these um, organizations that provide financial education to help kids and people who are not familiar with the stock market become familiar with the stock market. And more than anything, we're really spreading this information about why the market can be good. And even though it's a spooky time, it can be a great time to invest. So we're going to talk about it, and you might see our names in spooky font. That is on purpose. So, Leon, please tell people why we chose this topic, and I'm going to do some housekeeping.
Yes. The market. So Brent and I did a either a podcast or something inside our membership community, where we went over the worst months for the stock market. And what we pointed out was that the worst months are, on average, typically August through about the middle of October. The market typically picks up middle of October and then racing to the end of the year. We have what's called, everyone knows, that famous Santa Claus rally. But right now we're still in the middle of this pretty. I mean, this is like it's. I've never seen the market react to a typical move on cue like this one. Like if you go back, and again, this is kind of wonky, but if you look at a chart and look at August 1st, right about August 1st, right around then the market just dipped. Like, I mean, the seasonality, it's called seasonality when the market does certain things in different seasons. August, September, and October are typically the worst months of the year. Well, right on cue, as soon as August 1st hit, the market tanked. And so we're still kind of in this, as Brent would say, spooky, scary moment right now. But I just kind of want to go over some reasons why, well, aside from the seasonality, again, this being normal for this time of year, some reasons why we're also going through this. Biggest one, as we all know, is interest rates. But Brent and I have been talking about the Federal Reserve and the whole rate hiking thing the past almost 2 years. That's essentially likely done. The Fed is most likely will not raise. They're definitely not going to raise in November when they meet in a couple weeks. And it's likely they won't raise in December, just for the whole, the wars all around the world. Inflation is coming down slowly, but there's just a lot of headwinds the economy is facing right now. So they likely won't raise. But what's happened recently is the Fed is actually no longer in control of interest rates. I'm not going to get too wonky and too deep with it, but the bond market has taken over interest rates. I don't know if any of you follow this like I do, but so a lot of rates in the economy follow what's called the 10-year Treasury bond.
And also, too, just so you know, the 10-year Treasury normally is an indicator of what's going to happen with interest rates with houses as well.
Mm-hmm. So the 10-year follows the mortgages follow the 10-year. So do credit cards, so do car loans, things like that. So remember, the Fed hasn't raised rates, I don't think, in the last 2 or 3 months, but interest rates over the last 2 or 3 months have gone up. And when I'm quoting interest rates, I mean the 10-year Treasury, because again, that's what a lot of rates in the economy follow. It's up 1 or 2% over the last 2 or 3 months. Like rates typically in a typical year may move 0.5%, 25, either 1/4% to 0.5% in 1 year used to be considered a big move. Now we've had rates this last year move from 0 essentially to up to 5%. So it's been a historic move. That was the Federal Reserve controlling that. Like I said, the Fed is basically probably done because all the headwinds following that are facing the economy. But now the bond market has taken over kind of what interest rates are going to do. So say all this to say interest rates have skyrocketed the last, like I said, 2.5 months without the Federal Reserve doing anything. Reason being, primarily it's two factors. One, the economy is incredibly strong, and the Federal Reserve has come out and said, "Hey, in order for us to cut rates, we need to see the economy start to weaken, so we can slow demand." Because remember, what's driving inflation is all of us consumers buying up a lot of stuff coming out of COVID, pent up demand sort of thing. So the Fed wants us to stop buying stuff, so they've raised interest rates to make borrowing money harder. That's one thing. The other thing is that the federal government needs money to function, right? So this year, again, not going to get too wonky with it, but the federal deficit this year is going to be $1.7 trillion, meaning the Treasury is going to is flooding the market, putting out bonds to borrow $1.7 trillion. Now you say, why does that matter to interest rates? Because bond prices and interest rates are inverse. So as bond prices go up, interest rates go down. Right now, since the Federal Reserve is flooding the zone with bonds for people to buy, bond prices are going down and interest rates are going up. So the two primary reasons are: one, the government needs to borrow a lot of money, so that's pushing bond prices down, pushing interest rates up, and two, the market knows the Fed is not cutting rates until the economy starts to weaken. And the way they're going to know that really is by a lot of the unemployment rate going up. Right now, the unemployment rate is about 3.8%. They want to see that at around 4.5%, 5%. So until we get a meaningful deceleration in the economy and actually see unemployment start to tick up, the Fed is not raising rates. So all that in a package, the markets out here in the world is pushing rates higher because they know rates are going to stay higher for longer, going to stay high for a long time, and that's really, really, really challenging for the stock market. Remember,
Yeah, and also too, what happens is the stock market becomes a competitor.
Yep.
To the bond market. So imagine two competitors going side by side, and one is guaranteed, the other one has a risk factor that's undetermined. And so the government needs to get more people buying bonds because that's how it raises. This is one of the ways that the government raises money. It allows the U.S. or whoever the investors are, it could be foreign investors too, but essentially to become debtors to the U.S. So now they're buying these bonds. The government is indebted to them, meaning they have to pay them back at these stated interest rates. They need the money. Therefore, the rates go up to make them more attractive, and people have to go buy them. But what happens? A lot of people go, well, if I can move this risky money into this non-risky asset, that makes the most sense. And if, and again, you start talking about institutional money, they only need to make 3-4% on their money to be satisfied. And so if I can move from a speculative investment like the stock market into this guaranteed, it's not guaranteed, it's guaranteed the full faith that the U.S. government can pay them back, which is extremely safe. However, we can't say guaranteed, we can't use those words. And so it just naturally, people abandon in some ways what's called a liquidation. It's a liquidation effect, and they move that money into this guaranteed place. So that's the reason why.
And the thing about that is, so just think about it real quick. If you have $10 million, right? $10 million. Remember, the stock market on average returns 8 to 10%, let's say 8 to 12% per year. Low end 8, high end 12. 10% kind of the average. If you have $10 million, right, in your pocket, what would you rather do? Put it into a 10-year treasury bill bond that's going to pay you 5%, essentially, not guaranteed, but essentially guaranteed for 10 years, right? So on $10 million, that's $500,000 per year, essentially risk-free, right? No rate. You give your money to the federal government, every year they're going to pay you back $500,000 versus taking that $10 million and putting it into the stock market and seeing what we're seeing, have what's going on right now. Like the market, I'll just give some numbers. The market this year at its high was up, the NASDAQ was up 18%. Right now, the NASDAQ is up 10%. So what does that mean? The NASDAQ is down 8% from its recent high. So imagine if you bought when the NASDAQ was at its high, you're now seeing an 8% loss in your account. Same thing with the S&P 500. It was up 16% at its high. It's now up 7%, which means it's down 9% from its high. Again, Had you bought at the high, you'd be down 7%. So imagine taking that $10 million, putting it into a 10-year bond, making essentially guaranteed 5%, $500,000 every year, sleep at night, stress-free, or putting in the market and get the volatility I just talked about here. So this is why the stock market is having a really hard time with interest rates being so high on bonds, because again, big money can flow out of the market into the bond market and be very, very safe. And the biggest thing right now is the 10-year is approaching 5%. And that's like that big round number that the markets love. So if it gets above 5%, that's going to be a real big problem for the stock market. And when I say problem, I mean the volatility we're seeing, the up and down movements, because again, you have a lot of money that's either in the market or that wants to come into the market that's going to circumvent the market and go into bonds. So just in a nutshell, that's really why we're seeing a lot of this volatility with the market. One is seasonality. Again, as soon as August hit, history says the worst time in the market. It happened like clockwork. Interest rates are skyrocketing because the Federal Reserve needs to borrow a ton of money, or the Treasury needs to borrow a ton of money, which floods the zone with bonds, pushes prices down, which raises interest rates. And then the third reason is, what's the third reason? Drawing a blank. And it's rates, it's Fed,
and then also was the fact that the inverse relationship between the market and the bonds. So people are moving out of it's multiple reasons, right? But another reason would be people are moving from the speculative investment into something more guaranteed. Yeah. So that also affects the market.
Yep. So
jobs, making sure the jobs market has an effect on interest rates. Everything has an effect on it, really. So when you say what's the other thing, it's probably like 50 other things.
Yeah, other things. Yeah, right.
And so
just remember the two biggest ones are actually the biggest one is the Federal Reserve flooding the zone with all these bonds that are pushing price of bonds down and raising interest rates. So that's really the biggest one. Like I said, the Federal Reserve is probably not physically not going to raise rates again this year. Definitely not November, possibly in December, but it's highly unlikely because they see the trouble, all the headwinds, wars, the economy itself that the economy is facing. So they're likely not going to raise. But again, we're not going to see any relief from this pain we're feeling in the market until interest rates calm, until the Federal Reserve.
I think really until you probably see cuts.
Well, I don't even say cuts. If the Fed came out tomorrow and said we're done raising, like we're done raising rates, that would give some clarity, because the market would know, okay, hey, this is the ceiling in rates, and then now people are like, well, if rates aren't going any higher, let me buy these bonds at 5%. Because some people are actually. But
that's the thing. If you continue, you got to look at the existential causes now. Also, if the U.S. all of a sudden needs all this money, let's say for military reasons, and they have to raise money somehow, the easiest way for them to do it is to add 25 basis points to the bond market, or give people a reason to buy bonds again. And the way everything's looking, it could be a very real thing. And so in this space, everybody has to understand the way the government, one of the ways, because again, like Leon said earlier, or like we both were talking about, there are a million different ways that the government produces money. One of which could be taxes. It could be the bond market. It can be attracting new businesses to the U.S. and getting, whatever payments they're getting from the fees and so forth. It's just, you don't know. We don't know. We could assume, and historically, like the market is doing what it normally does right now, but also we're still in, don't forget, we just came off this perfect storm, right? You got semiconductor shortage. You have the interest rates still are technically, they're going back to a place of normalcy, but for many new investors, they've never experienced this type of market, so it feels abnormal. So this adjustment period is happening right now. So it's a lot of reasons why the economy is just all over the place. We're going into an election year. It's going to be interesting over the next 24 months.
But as we pointed out before, and we'll say it again, these are the times you want to be buying, because as I said, this is the worst time in the market historically, August through middle of October, which means this is where the market pulls back the most during the year. And every time since the beginning of time, since the beginning of the markets, the market has gone up, right? The market has recovered and started to go higher. So if you're looking to buy, if you're looking to put some money to work, now is the time. Will the market race to new highs by the end of the year? I have absolutely no idea. Probabilities say we'll likely be high from where we are today by the end of the year, but I can't guarantee, but I can with high confidence say in the next 3, 5, 10 years, the market will be higher than where it is today. So that's what we're saying. Now is a really good time to buy for the long term. Long term to us is minimum 3 years, but really out 10 plus years. So
and I'll say this too.
Hmm?
People got to ask themselves, what would Warren Buffett do?
Yeah, he has a saying that's he has a saying that says when there's blood in the street, I forget the saying, but basically says when you feel the worst of the market and you're the most scared, that is the time to buy. And we are at that moment right now because we are at a moment where, I mean, things are terrible, terrible. So,
yeah. And with that said, we owe you all two things. Those are 2 stock picks. So we will be giving you those stock picks, and these stock picks may be coming by way of Investica. We have to work on it. We're trying to maybe get some sponsorship deals between Investica and Investing Education Academy. So I'll talk to the owner, see if I can work anything for the Investing Education Academy community. But either way, we owe you 2 stock picks, and I know I'm joking, but at the same time, it's a very real statement. And so we have some things on the horizon that look absolutely amazing. We look forward to you all joining IEA. And for those of you all who are in our community and getting the other things that Leon and I talk about inside of the community, you know that, you have to be in the community to know. So I won't even say anything. Thank you for everybody else who, comes here, listens to us live. We appreciate you all. And for those of you all who have subscribed to our podcast, thank you for doing that. Now, we do urge all of you all who like to see these podcasts live, you can go to YouTube and search Investing Education Academy. More than likely, we should pop up. And please subscribe to our channel. We would like to grow our channel to a specific number by the end of the year. We're not going to tell you. We just hope that you share this information and you continue to drive up our subscribers. It will definitely help us, and we will continue bringing this information. But it's also helpful when the subscriber base is growing.
And also, if you want to hear the audio version, you can go to IEApodcast.com. IEA podcast with, I can remember the S or no S?
No S.
IEA, no S. IEApodcast.com. If you want to get the audio version, but like Brent said, if you want to see the visual version, you can go to YouTube.
Yep. So everybody, thank you for being with us. We look forward to seeing you in 2 weeks. And if you're looking for those stock picks, please log into IEAmembers.com and you can find the stock picks inside of the member platform. If you are not a member, this will be a great time to join. Again, we have plans to start $18 a month all the way up to $5,000 a year. And the $5,000 a year plans will be changing probably pretty soon to $10,000 a year. So if you're interested, you should get in contact with us sooner than later before those 2 slots are gone.
And everybody on that, that's a group where we actually invest together. So we actually have what we call the Portfolio Panthers. It's a group of about 11 of us,
12
of us, and we invest in. We have a deal. We have 2 deals right now we're investing in. Everyone knows about the deal we did last year in Ghana, the beachfront property we bought. But we have 2 other deals that we're investing in soon. So it's that much for a reason, because again, we invest as a group in private equity deals that Brent and I sourced, bring to the group. Then we decide as a group if we're going to invest or not. So,
yeah, we have a new person pitching to us in the next 2 months.
Yep.
So, these deals are coming, and if you're interested in joining these deals and we're moving into real estate, let us know. If you're not, we'll still, give updates on things that are happening. And we're also buying into a marijuana company right now. And that is extremely exciting. Even being in contact with the owners of this company has been a journey of learning and working with our lawyers to make sure we get the best deal possible. So we're changing, we're growing. We hope you're a part of it. Either way, we'll tell you the stories along the way. Have a great day, everybody.